Hello and welcome to Market Domination. I'm Josh Lipton, live from our NYC headquarters. Stocks trading higher here amid lingering government shutdown concerns. We're going to be digging into that story, but right now there's just an hour to go until the closing bell. Let's take a quick look at the popular averages and see how we are trading. The Dow is up about 61 points. The S&P 500, your broad gauge, is up about 0.2%. Your tech-heavy NASDAQ is up about 0.5%. Let's welcome in Washington correspondent, that would be Ben Werschel. We also have data and markets editor Jared Blickery joining us to break down the headlines. Jared, my friend, let's head over to you first for a look at the trading action so far.
Thank you, Josh. Things are looking broadly bullish today, although not huge outside gains, especially in the Dow here, up about 60 points or 0.1%. And let's just take a look at the intraday price action. We've seen some red, we've seen some green. We're seeing a little bit more green in the NASDAQ right now off of those highs that we saw earlier in the session. And the S&P 500, about half what the NASDAQ is doing, also a very similar chart. And I do like to check in on the small caps, and guess what? The Russell 2000 looks a lot like the Dow right now. But let's take a look over at the bond market. We're seeing some pretty sizable drops in yields, 5 basis points for the 10-year T-note yield to 4.14%. And then in the 30-year, seeing 6 basis points to the downside, 4.7%. Also seeing a weaker dollar. You add all of that up, that's broadly supportive of equities. They tend to like the lower dollar and lower long-term yields. Excuse me, so that's what we're seeing here. And if we take a look at the sector action, we see the leader is tech once again. That was lagging a few times last week, but now we got that in first place, communications services in second. That's an Alphabet and Meta story there. Then we got materials, consumer discretionary, so that rounds out all the mega cap sectors, plus financials, industrials on the top row. Today we see energy taking a backseat. It did very well last week because of crude oil jumping. Not so today. Staples also slightly in the red, but not by much. And let's check out the Nasdaq 100 rather, where we see Nvidia back up over 1.5%, and some mixed action in the mega caps. Looks like Broadcom is down about 1.8%. But I want to dig into the semiconductors here, where we're seeing some pretty good strength in some of these names. Not broadly all around, but Micron's up 4%. I was just talking about that with Cory Johnson. He's going to be here later in the show. WDC, Western Digital, up almost 8%. And if we look in software, pretty similar story. We see a little bit of red, but also some outsized winners here. Shopify up 6 point, EA up about 5.5%, excuse me. And also looking at some of the smaller names in disruption. Aside from Tesla, already hit Shopify, but Roblox up 4%, Coindesk up 6%. Hood up another 11, and if we take a look at China, China's green too. And I'm going to go on to some meme stocks here. So all in all, we're seeing some bullishness in different parts of the market, not hugely, but enough to get my attention, especially as we close this month, which was supposed to be bad. But remember, September on average the most negative month on the year, but not today.
All right, Jared. And with a partial government shutdown looming and fiscal differences unresolved, President Trump holding an Oval Office meeting to push toward a last-minute breakthrough. Ben, what are the stakes and what is next?
Yeah, as you mentioned, the Oval Office meeting is what we're waiting for. It was scheduled to start at 3 p.m., but it's been delayed at the White House. President Trump is currently in the middle of a press conference with the Prime Minister of Israel, Benjamin Netanyahu. But when they eventually get together, this is Trump and the top 4 congressional leaders, 2 Democrats and 2 Republicans. This is what all eyes are watching, and the expectations at the moment are pretty low as to sort of how these two sides, who continually are just talking past each other, can come to a deal. A range of issues kind of are still outstanding. One I wrote about today was about rescissions. This is Washington speak for the president's ability to essentially unilaterally cancel spending. The Democrat case there is basically, why would we negotiate with you if you're just going to cancel whatever we agreed to down the road? So there's a lot of distrust on both sides, and both sides have shown little to no evidence of any kind of blinking at the moment. Healthcare is another major flashpoint we saw today. That was a kind of off-ramp that was seen as possibly a way to avert this, but Democrats appear to be batting it down. One thing I'll be watching, especially in this meeting this afternoon, is basically whether or not we see it. The expectation going in has been that this is going to be a political theater moment, kind of a time for all sides to yell at each other in front of the cameras. As for the moment, this could change any minute, is that cameras aren't going to be allowed in so that the two sides may actually have some level of negotiations. We'll see if there's any progress that they can make behind closed doors, but again, that could change any minute, and reporters could be allowed in. One headline that just crossed a minute before I came on that I think is kind of emblematic of how little expectation there is for any sort of grand bargain here. Axios just crossed a headline that Chuck Schumer is floating a plan that would avert a shutdown, but for only 7 days. So you would kind of delay things for just 7 days to kind of keep this fight going a little bit into October, but very, very few expectations that we're not going to be talking about this all fall.
All right, Ben, Jared, thank you guys.
Sure thing.
Well, government shutdown is once again on the table. According to 22V Research, the odds jump into 60% as President Trump meets with congressional leaders ahead of Wednesday's deadline. For more, we're bringing now Kim Wallace, Senior Managing Director at 22V Research. Kim, great to see you as always. So when clients ask you, Kim, your latest government shutdown odds, what are they, Kim? Walk us through it.
Well, Josh, I was at 60% up until last Wednesday that there would be no shutdown. And then with developments of the president canceling a meeting with Democrats and interviews that the House Democratic leader Jeffries gave on Thursday night, I reversed. I went to 60% chance of a shutdown, and I stipulated to our clients that we'd watch Sunday. Developments on Sunday usually give you some sense of these short schedules. Well, the president accepting the meeting, neither side is going into that meeting to convince the other. And with Democrats increasingly understanding that their top issue, which is health care, is hard for them to execute for their constituents in a shutdown, led us back to 60% today that there will be no shutdown. I've watched these things since the bad ones back in the 80s. 3 days out, if you're really headed for a shutdown, you don't have many meetings. And you certainly have many more members on each side pounding their chest, trying to explain why shutdown is the only way to do business. You haven't heard that from either side this time. So for a lot of reasons, I think odds are low and going lower of a shutdown.
Let me ask you, Kim, if there was a shutdown, I'm just curious, who do you think the American public would blame for that?
That's one of my main reasons why I doubt either side is going to force this. No one wins these. The history shows of the 5 longest, 2 of them happened in the 70s. They were caught up in Watergate. Those shutdowns helped Democrats in the midterms of 78. The longest one on record was in the the beginning of 19. There's no evidence that did President Trump any favors in 2020 or his party. And in between, the fiscal 2014 shutdown that was at the end of 13 obviously stung the perceived instigator, then Senator Cruz, who hasn't returned to the shutdown scene in the decade plus since. No one wins these things. Eventually, the American population blames Washington for dysfunction almost equitably. I think it's really hard for a unitary government that has had a really strong role the last 8 months in the economy and in geopolitics, pretty much achieving everything it has set out to do in the campaign, to make a case that Democrats are to be blamed for government dysfunction. On the other side, Democrats want to highlight what they perceive as bad healthcare policy from Republicans. It's hard to do that if you're in a shutdown, because then the shutdown becomes the top line message and story 2 and 3. It's much easier to do if you are fighting on the floor of the Senate and in committees, highlighting what you think are the shortcomings of previous healthcare policies and ones coming up, including the Affordable Care Act tax benefit that expires at the end of the year.
So we're placing our bets here, Kim, whether a shutdown occurs. I'm going to watch this meeting very carefully. I know an important question investors have, Kim, is if there was a shutdown, hypothetically, and you try to play this out, game this out, how long you think such a shutdown could last? How do you try to advise and guide clients about that answer?
Josh, it's a good point this week in particular. We have Yom Kippur this week. And so if a shutdown begins at midnight October 1, it will be very near impossible for Washington to cut it off sooner than 5, 6, or 7 days. Very near impossible. the risk both sides run once you get into these things, and I think the 2013 episode was probably the most salient. Once you get into these things, it's very difficult to put the path back to peace together. Partisans on your side think they're winning. They want to see more pain on the other side. People on the other side, in this case, the opposition, want to believe that they are highlighting the just cause. And in the meantime, after a week, you start to see payments slowing. You start to see constituents concerned about benefits and their payment on time. Dysfunction starts to creep into the government, whether you believe this is the most dysfunctional government you can remember in time or not, or if you think it's the best and most effective. At some point, beginning week 2, you begin to feel constituents ire because government is not working, and they really don't know why. There's not a defining issue here between Republicans and Democrats that would force them to close the government, as opposed to do what democracy was built to do, debate and act.
I'm curious, Kim, what did you make, finally, of the Trump administration's threat there to potentially use a government shutdown to permanently dismiss federal employees?
My first reaction is they're doing that now. They've been doing that for 7 months. And the Supreme Court has just recently given them reason to believe they have unfettered ability to do this. I'm not sure that a shutdown is an incremental improvement in their toolbox. It does, however, that shutdown would point out that those layoffs and shuttering of agencies, or parts of them anyway, will take people back to the February-March period when Elon Musk was using his effort within government to reduce payrolls. Politically, that did not play well for Republicans on Capitol Hill, and it was part of the pushback that came with the March-April trade announcements that caused the White House to back down on April 9. There was just too much going on, most of it being negatively received across the political spectrum.
Kim, always great to see you. Thank you, sir.
Be well, Josh.
Coming up, Oracle may be one of the best stocks of the year. It's according to one expert joining us. We're taking a deeper dive there. Plus, Oklo is on the rise and getting new analyst initiations. We're going to explain why. And Alibaba making moves. We're telling you everything you need to know. Those stories and more coming up. The tech-heavy NASDAQ is poised to build on Friday's rebound, but tech stocks in the hot seat as rumblings grow over concerns of an AI market bubble. Cory Johnson, Epistrophy Capital Research Chief Market Strategist, joining us now to discuss. Cory, great to see you, especially on set.
Here,
in the
New York
flesh.
City.
In the flesh.
Skyscrapers and everything.
Let's talk big picture.
With a Stevie Wonder reference.
I got it. AI bubble.
Yeah.
Talk of this. I heard Ken Griffin telling CNBC echoes of a dot-com bubble. Mr. Griffin say David Einhorn, smart guy,
great short
throwing red flags on all this AI spending. What do you think? Do you hear echoes of a dot-com bubble?
There are sounds that sound familiar, like customers trading things other than cash for product, right? We've got NVIDIA selling chips in exchange for compute, and both sides maybe recognizing it as revenue. I think that these are things that accountants should look at. We see the companies making deals with other companies making deals with other companies making deals, and sometimes cash is not the thing that is being exchanged. That is something we saw in the dot-com.
And this concerns you? You hear echoes?
These sound like the things we heard during that era. We certainly have some fake AI companies out there. We have companies that put AI in their press releases so they can get boosts in their stock.
It's marketing fluff.
There were some of those, and I'm sure I've been short some of those companies. I'm currently short some of those companies in my little portfolio. I don't give investment advice, but I want to, full disclosure. But I strongly believe that the use of AI is only just beginning, and that the chips and things that are being sold into the build out of these data centers are being used. They're not just selling capacity, as we saw when dark fiber was being laid for the future of the internet in 1999 and 2000, when it was just there were a lot of accounting scams of companies like WorldCom and Global Crossing and Quest and others. These are names you may not even remember or have known at the time, but these were the big companies of that era, some of them. And some of them proved to be complete frauds like WorldCom and indeed Enron.
So I see how, listen, consumers are using AI to your point. So ChatGPT has, it's like 700 million monthly active users.
Sure.
I'm one of them, full disclosure. But do you see, what does the AI adoption curve look like in the enterprise?
It's fantastic. There isn't a single company I talk to, and I talk to CEOs every single day, there isn't a single company I talk to that isn't talking about new use cases of AI in the workplace. Now, yes, there are a lot of CEOs saying, I know I need AI, I don't know what I'm supposed to do with it. Those guys are going by the wayside because the adoption of AI in the workforce is just beginning, and it's really amazing. The buzzword in Silicon Valley right now, you're hearing on this show as well, as agentic AI, which is AI that will make decisions for you. AI that you'll say, can you figure this thing out? And if you figure this thing out, can you do this thing? Which is to say, can you go to the second derivative? Can you be the agent in this? I don't want to just get in a car and tell it, give me a map. Get in the car and make the decisions and drive me. That's agentic AI. And that's the trust level, too, you've got to have. You've got to believe that it's going to make decisions down the line that are the right decisions. And we're just getting started with that, but that is certainly the buzz that we're hearing. And we're hearing that a lot. There's a lot of technology conferences happening. Oracle AI World is happening in Las Vegas in a few weeks. The same week, Dreamforce is happening in San Francisco. Agentic AI will be the buzzwords out of these events, promise you.
You mentioned Oracle. Yeah. I know you're a longtime fan. Are you still a fan?
I'm a shareholder.
Yeah,
so full disclosure, it's a company that I work with sometimes, and I like some of the people there a lot. I'm really bummed to see Safra Catz leave.
I meant to ask you, what did you make of changes in the C-suite there?
She does not get the credit and respect she deserves.
Too much to Larry, there should be more for Safra, you say?
I can't say too much to Larry, but I can say too little to Safra.
We should spread the love around more evenly. That's your point.
Safra Catz is one of the most incredible stories in the history of technology.
How so? Why?
She has gone from being a banker at DLJ to being a self-made billionaire, if you will, what she's done at Oracle. She has created so much value. She has steered that company to a place of relevance that people did not expect. I met with the CEO last night. He said, Oracle? Out of the blue, didn't know that I was involved. Oracle. Who would have picked Oracle? I'm like, Oracle. Oracle's been telling us this is going to happen for 3 years now, and it's been happening. I was lucky to be there with a big position for the Johnson family, and I'm still there. So I'm totally biased. If you're listening to this, you can disregard what I say, but they have been telling us about this build out in AI. They've been telling us about the shift to the cloud. They've been telling us about this modular data center architecture that will allow all kinds of companies to go in. What they weren't telling us is that TikTok was the customer that was carrying them to grow out the business so that others could come, and now they're getting the rest of that business, and they got this huge order from OpenAI. A lot has to happen for them to get there. But it's an exciting time for Oracle.
One other name I want to get in here quickly, because I haven't heard you talk about it, at least on this show. Coherent. Why is that a buy?
Didn't know you were going to talk about that. Another stock that I own. So one of the things we're seeing in data centers, we've gone from data centers being a thing, from AI happening in a system or even a wider system or even a rack, scale in and scale up, which is build data centers that can do large language model training. But what we're starting to see is bigger models that involve kind of growing out and even scaling out to inferencing. So inferencing happens on a training model that's running over a wider and wider area. Well, what do you need to get to a wider area? Connections. And those connections, copper isn't doing it for those connections. Jensen Huang says copper as long as you can, and then optical. Well, optical is where we're going to be going, and we're already going in the data center. So you're seeing fantastic growth at all kinds of companies, some stocks that I own, some that I don't. I only own a few stocks, but Coherent and Oracle being two of them. But Coherent, Fabrinet, a company that makes some of these things, another stock that I own. Light is another stock ticker, LITE, a company that I don't own that's out there making these things. AAOI, another stock a controversial stock that I own that is building out some of these systems. But the ability, Ciena, another company that I own, Cisco is going to be in the mix here. Companies that are connecting data centers to other data centers. Look at the stock of GLW, the stock of Corning. Creating more fiber to connect these systems to each other with a scale out of data centers is going to be a really big business. And that's just one of the things that's changing when it comes to the build out of data centers and the future of AI. And this stuff is real. This stuff is being built. There are some BS companies in here. I didn't say it. Can we say that?
Sure, you just did.
I just said BS. That's all I'm going to say.
Oracle, Coherent, Stevie Wonder, we covered it all.
Well, there's more.
Thank you. Coming up. Thank you, Cory. All right, now time for some of today's trending tickers. Epistrophy Capital's Cory Johnson still here with me. Take a look at a few names. Oklo, coal stocks, Alibaba. Let's start off with Oklo, though. That stock getting an equal weight rating at Barclays as the firm initiates coverage on that stock. So Barclays actually initiate coverage of nuclear companies. For Oklo, they're overweight, a leverage play, they say, on small modular reactors. Target is 146. Of course, this one has already enjoyed a monster run here, Cory. And by the way, broadly, the street still likes it. New Scale Power, they went equal weight there. So lukewarm on that name. That target looks like 45. What do you make of these calls?
Okay, if you want to buy these stocks, you got to know about Halo.
Halo, talk about Halo.
Not the Beyonce song, that's different. Halo is high assay, low enriched uranium. If you don't know what that is, you shouldn't be buying these stocks.
What is it?
So low enriched uranium is what's used in most nuclear facilities. It's under 5%. I can't remember the assay number, but it's like U235 or something. But it's 5% enriched uranium. Enriched uranium, of course, in the news with the war against Iran and the bombing of an enrichment facility, that's above 20%. Between 5% and 20% is HALEU, the high assay, low enriched uranium. So that is the uranium that they want to use in the Oklo reactors that don't exist. So even if they can build these reactors, even if they can build them in the cost realm that they say they're going to build them, which has never been done before, even if they can get approval from the Energy Department, which they have not been able to get, they've been rejected in the past when they've applied for this. If you think they can do all that, where are they going to get the fuel? There is no commercial grade HALEU made in the US. You can get it from one place, Russia. You think we're going to go out and buy mountains of low level, and not low enriched, but HALEU enriched uranium?
I'm hearing skepticism.
I'm just saying, if you're buying a stock, you got to believe this is going to happen, or the US is somehow going to make this thing that is not made right now, and at the prices these guys say, $5,000 per kilogram, when it's probably more likely to be 5 to 7 times at it. 21 to 35,000 per kilogram is probably a more likely price if they can even buy it, if it can be even made.
It's a lot of ifs.
A lot of things have to happen in the future.
It's a lot of ifs.
And zero revenues for Oklo.
A lot of ifs. Awesome. All right, turn out, here's the one. Coal stocks, those shares getting lift as the Trump administration invests $625 million to support power plants. All right, so this one, helpful summary by our friends and former colleagues at Bloomberg. Trump administration opening around 13 million acres of federal land for leasing to coal miners, Cory. They're going to provide $625 million for power plants that burn the fuel. Obviously trying to help an industry here. What do you think?
Nobody wants coal.
You want to buy Peabody?
Nobody wants coal. Nobody wants to build with coal. Nobody wants to build power plants with coal.
You know who wants it? Chinese want to build with coal.
Not so much. Chinese want to build with solar. Chinese want to build with wind.
Isn't coal production still in China just off the charts, I thought?
The biggest development of energy in China is in renewable energy sources and some petroleum sources as well. And what we see, the fastest way to get energy into our grid is solar and batteries and wind. Coal's further down the line. Gas may be a good bridge.
So what do you say? Here's if I can channel my inner Trump administration, they would say, "Hey, it's abundant, it's cheap, and why should we handcuff ourselves channeling if China isn't going to?"
And it's not cheap.
Yeah.
It is not cheap to operate a coal plant. It is cheap to operate a solar facility. It is cheap to operate a windmill. Even if Donald Trump is very worried about birds, I know he's a great bird ornithologist, cares a lot about nature. You see him with those binoculars around his neck. I think it's actually for the golf course to find his ball. But in truth, solar is the cheapest way to develop power in this country. Wind is right behind it. Batteries right behind it, and wind is right after that. And these are just true facts. And this is where the best way to make power, the cheapest way to make power, and it turns out to be renewable. But it's fast, it works, and it's cheap, and that's going to work better than a government pushed source. There's not a free market decision here. The free market is ultimately going to win here, and the free market is picking solar and batteries and wind over a government subsidized coal.
All right, lastly, Alibaba, I want your take on this one too. Got a price target lift at Morgan Stanley. So this one, all right, Morgan Stanley weighs in. They raised their cloud growth estimates to 32% for 26, 40% for 2027. They talk about increased CapEx, model upgrades. They talk about strategic partnerships, accelerated international expansion. This stock's already up around, we should mention, about 110% this year.
So one way to think about Alibaba right now is think about it as Amazon. not Amazon for selling stuff, which is not a search engine, but think about it, they're Amazon Web Services like business. They've been very successful with their cloud business, offering that up in Brazil, in Europe actually, as they're looking at France, as well as in China. But the concern there is 7 nanometer. We're back to science again. How I became Mr. Science, this is not good.
But you're good at the role. That's why we bring it back.
Right down the street at NYU.
That's why we bring it back.
Science grades, not good. Chemistry, not good. But I didn't take chemistry down the street. In any case, I did go to class occasionally at NYU. But 7 nanometer is a limit here, right? So when we have semiconductors for the rest of the world going to 2 nanometer and 1.4 or 14 angstrom, as they like to say at Intel, when that's where semiconductors are going the rest of the world, and China is stuck at 7 nanometer, Huawei is doing amazing things at the 7 nanometer limit. But fundamentally, Alibaba's data centers are going to be limited with slower, hotter chips that don't have the value and can't do the compute that the rest of the world will be doing. We'll see how export controls matter in Brazil, in France, for Alibaba data centers there. But fundamentally, Alibaba is going into this with one hand tied behind them in terms of the inability to get the best chips to do the best AI, which is where data center growth is going to be.
Cory, we're always lucky to have you on the show, especially on set.
Glad to be here.
I think the only regret I have about leaving the Bay Area, I don't get to see you as often.
Well,
this is
you see me down that little screen over there.
I know, but it's not the same. It's not the same.
We'll have to work that out. I've got a kid going to NYU in the spring, so
I'm going to see you more often.
To my clients out there, there's a price hike coming soon.
Thank you, sir. Great to see you. Coming up, October, around the corner. We're looking at seasonality in the markets and what to expect. Stay with us.
September was supposed to be the worst month of the year, and it's almost in the books, and it wasn't even that bad. Today, we're going to take a look forward to October, and we're going to be breaking down seasonality. So let's do that real quick here. Seasonality is the predictable and recurring changes in data that happen at about the same time every year. And we take a look at it sometimes a presidential cycle, it might be every 4 years, but the bottom line is we're looking for recurring patterns. And so let's start with this bar chart first that shows each month having a return, and this is just the median return since 1990. And the median is kind of like an average, except that it's not so skewed by large outliers or underliers there, to the upside or to the downside. And here's where we are right now. We're still at the end of September. As I mentioned, it was supposed to be the worst month of the year, but actually it was pretty good. And in fact, we were expecting the last 6-7 days to be all negative, and we got a few bouts of negativity in these days, and we still have 2 more closes to go. But nevertheless, we're probably going to close with some decent returns, at least in some of the indices. Now we can look forward to what is the most positive quarter of the year. And I'm going to be breaking this down in part tomorrow too, the 4th quarter. But today I just want to cover what's happening with October. And here's another look at the full year. In white is what has actually happened. And you're going to note here that this was a big post-Liberation Day sell-off and that quick recovery, which is one of the quickest returns to highs that we've ever seen in the market. And then I have 2 different models. One is a median since 1990. That's in green right here. And in blue, we have the median since 1928. And that is where each day of the week has to match what we are in presently. So if, for instance, it is Monday, September 29th, we just have to look at those Monday, September 29th throughout history, except we're mapping this into October. And you can see here real little that we did have this sell-off in the white line that kind of matched what we were expecting in that median since 1928, same day of the week. And that has actually become my preferred model. This has become a pretty good predictor of what's happening. So here we have that same model, median since 1928. And let me just trace out what we are expecting for the month of October. And you can see we rise pretty quickly in the early part of the month, and then we kind of drift lower into the end, but then we got a little bit of a bounce at the end. And we also have that other model, median since 1990. That more or less kind of revolves around the unchanged. It goes slightly negative in the middle of the month, and then delves into the positive towards the end. The point is, depending on how you slice and dice the data, you can come up with wildly different models. And so I'm not trying to confuse people, but there are different ways to do this. And so you might see some different seasonality results from different people who are doing a lot of these studies. But again, my favorite here is median since 1928, same day of the week. And for that, we are expecting some outsized performance in October. Now I want to move on to a different market. This is the VIX, and in white we have the average VIX since 1990, which is when it began, and then in green we have what's happened this year. And the VIX responds to volatility, and it's looking forward to options changes, basically what the options market is saying about changes in the S&P 500. And what sticks out is this huge spike. That was a Liberation Day spike that we got there. And what you're going to notice is even though the model, the average drifts up into October, and that's when we've seen a lot of market crashes throughout history, we've seen muted volatility so far. So the potential is for volatility to rise. We just haven't seen it just yet. So to review here, we have performance leaning positive in October. Volatility tends to rise. Notwithstanding that, I also want to point out that we have more than average trading days. Usually it's 21. We're dealing with 23 here. And also for Indigenous Peoples Day on October 13th, stock markets are open. Bond markets are closed, and your bank is probably closed too. So having said that, tune into the next Stocks in Translation podcast for more jargon-busting deep dives. New episodes can be found Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts.
Key economic reports could vanish if a government shutdown happens, taking with them critical signals for the Fed. John Hilsenrath joins us to explain how missing jobs, inflation, and spending data could blink policymakers and what that means for markets and monetary policy. John, great to see you. So, all right, we're on government shutdown watch, John.
Yeah,
we're
seems
waiting.
like we get one of these every
We sure
few
do.
years.
It sure does. But let's say it happens, all right? Everyone's placing their bets. If we saw that happen, that could mean, John, potentially what for the pace and publication of that all-important government data, the jobs data, the inflation data? What does it mean?
Well, it's the jobs data that really matters in this particular case, and also the next round of inflation data, because from the Federal Reserve's perspective, they meet again in late October. They only get one more batch of data before they have to make a decision about whether to cut interest rates again, right? So if we don't get the October jobs report, or if we don't get the October inflation report, they're flying blind going into the next meeting. It makes it a little bit harder to make a call that's already a little bit of a close call to begin with. Now, these shutdowns, they tend to wash out. They tend to be non-events for the economy and for the markets, but there's a little bit more at stake this time. And it's also, frankly, kind of hard to see what the incentives are for either side to compromise with each other on this one.
Could private sector data, John, fill in some of that gap or no?
No.
It couldn't.
No, I mean, we have ADP data, for instance, on the employment on the jobs front, but it's very often far away from where the BLS, a deeper, richer study tends to go. So, from the Fed's perspective, though, it's not necessarily going to take private sector ADP data to heart, but it's going to look at how the markets respond to a shutdown and how they're positioned going into the next meeting when they decide what they want to do.
So if you have the shutdown and, okay, now we have some interruption to the data, what does the Fed do in that situation, John, with the next meeting on deck?
That's what I'm saying.
Yeah.
It's a tough call for them to make with only 1 month of data before the next chance they get to look at. I mean, I think they take a lot of cues, not necessarily from private data like ADP, but from the markets. How are the bond markets behaving? What are the futures markets pricing in? What are forward markets pricing in for a move? The low risk thing to do would just be to stay on hold until you get to see more data. But if the markets right now are priced 90% for a rate cut in October, and if the Fed doesn't deliver something the market is expecting because it's flying blind, it could cause some turbulence.
Is John Hilsenrath at 90%?
No.
No, how come?
No, because if you listen to Fed speakers this week, the last few days, and if you listen to what Jay Powell was trying to say at the last Fed meeting, they want to have a little bit of wiggle room. There's still an inflation problem. It hasn't gone away. We had a couple of Fed speakers today, Beth Hammack, Alberto Musalem. They're still talking about, inflation is a percentage point above the Fed's 2% target. There's some aversion to going too far on this. Now, there's the Trump appointee, Stephen Miran, who's making an argument the Fed should do a succession of half-point rate cuts. He doesn't have the rest of the FOMC on board with him on that.
I saw an FT poll. I'm going to ask John about this. I got to get the Hilsenrath response. Did you see this one? They polled academic economists, all right? Overwhelmingly, they want Waller to succeed Jay Powell. That's what they want, John, 82%. but few think, according to this poll, he's going to get the job. Hassett, they say, Kevin Hassett is seen as the man most likely to head the Fed. What is your take on that poll?
It's funny you should ask that question because I do a survey myself with Duke University.
Did it dovetail with this?
In some ways, and it actually adds to it. I survey former Fed officials, former governors, former regional bank presidents, former senior economists there, ask them the same question. In fact, I think maybe the FT came after me. Ask them the same question. Unanimously, they say Chris Waller, and they also express some skepticism because they think he would be most independent. Not a single person voted for Kevin Hassett in my survey of former Fed officials. So, and I think it's important for this reason. I think if Waller were to end up getting the job, you see economists saying this, you see former Fed officials. I think that's the guy that the markets would feel comfortable with. So to the extent there's some concern about Fed independence, the Fed's determination to get inflation back to, I think the market would feel comfortable with Waller. If Hassett gets the job, he's going to have to do a little work to build his own credibility, not only inside the institution, but with the marketplace.
John, great to see you. Thanks for coming on.
Thanks so much.
Well, the housing market showing signs that lower mortgage rates may be pushing some buyers and sellers back into the market. And Yahoo Finance's Claire Boston joining us now with the very latest. Claire.
Hi, Josh. So we saw pending home sales be unexpectedly strong today. They were up 4% when economists were only expecting a very small increase here. And pending home sales are contract signings. So this is any home going under contract. Not all homes that go under contract make it to that closing state. But this is a little bit of a bullish sign for the housing market when everything has been very, very slow. We're on track right now for the slowest year in 30 years. But these pending home sale numbers make me wonder, could we potentially see a little bit of an upswing in housing activity later this year, just because mortgage rates are going a little lower now?
So, Claire, let me ask you, pending home sales beat. Last week, new home sales, correct me if I'm wrong, they beat consensus.
Yes.
So if an investor, I'm kind of wondering, all right, Claire, is this sustainable? Does this have legs?
Yeah, that is a great question. It is something I'm asking a lot of experts, and they do not know. The pending home sales and new home sales are both relatively volatile, and so many economists and experts say, potentially we may have overshot here. We may get a little bit of a revision. That being said, there are green shoots, and that is because mortgage rates are falling. Mortgage rates at the beginning of August were around 6.7%. They ended August at 6.5%. We're at 6.3% now. And basically, we're at a state where any move lower is going to unlock probably some people and get them off the sidelines. So if that can continue, maybe we will get a little more housing activity to end the year.
All right, Claire, thank you. Appreciate
Thank
it. Coming up, gold prices shining with a new high. How far will this climb keep going? Stay with us. We'll have more on the metal when we return. Gold continues to shine, breaking past $3,800 per ounce as investors rush towards safe havens. Amid mounting risks, senior markets reporter Inez Ferre joined us to walk through what's driving this rally and whether gold's next leg up is sustainable. Inez.
Yeah, Josh, and as you just mentioned, a massive monster rally that we've seen with gold this year, and today's all-time high prices as well because of the threat of a government shutdown. You've also had this year, of course, central banks purchasing gold, and we've talked a lot about that and the Fed easing cycle, which began this month. But look, it's really also the dollar weakness that has sent gold prices higher. If I pull up a dollar chart, you will see that over the last, this past year, we've seen that the US dollar has gone down about 10%. I'm having difficulty pulling up that chart, but nevertheless, it's gone down 10%. That creates an outsized move really when it comes to precious metals. And I want to point out silver as well, because silver has actually outpaced gold. Silver is up 58% year to date. Gold is up 45% year to date. So we could be seeing a bit of a silver squeeze as we're watching right here. But nevertheless, this is not too far from silver futures all-time high closing back from 1980 when that closing was at 48.70. So watch out for silver touching record highs in the coming days and and weeks if this rally continues. But as far as whether this is sustainable or not for gold, which is closely watched by Wall Street, look, Goldman Sachs has a forecast, a base case scenario forecast of $4,000 per ounce for gold by mid-2026. We're looking at $38.50 right now. So that would imply perhaps some pullbacks here and there. They have talked about speculative buying in recent weeks. So that's a risk to watch out for, because when you have that, then you may have some pullbacks along the way. But Goldman also sees a case for $5,000 gold, a bull case, by the end of 2026. So Wall Street is still bullish structurally on gold because of that structural demand that we've talked about that's been happening over the last couple of years, despite the fact that you may see pullbacks along the way.
All right, Ez, thank you. Appreciate it.
Thank you.
Bitcoin is back in focus with prices moving higher today. Investors are looking for the next breakout catalyst to drive the cryptocurrency back to record highs. For more, I want to bring in now Samir Krabaj, Hashdex Chief Investment Officer. Samir, it's good to see you. I want to start off kind of big picture thoughts, Samir, you have on Bitcoin, because I'm just looking at the chart here. You know, we're in the green today, Samir, but you've basically been in this trading range really since mid-July, so 2.5 months. What do you think, Samir, explains that? And then what do you think is going to take to drive Bitcoin out of this range and to fresh records, Samir, to that next big number, to 150,000, 200,000? You know, what are the catalysts on your horizon?
Okay, Josh, it's great to see you again. I think that there's a lot of things happening in crypto. We certainly had a great year. Bitcoin's going up like more than 20% this year. Other crypto assets like Ethereum or XRP going up like 25 or almost 40%. So it's a great year for crypto overall. Like you said, we've been trading in sideways in the last few weeks. And I think this is mostly, the absence of news, basically. The macro environment, we're waiting to see how like the interest rates are going to impact the economy, the inflation numbers that are coming. So there's all those concerns around the economy. I believe that the next level, the next wave of crypto adoption will come from stablecoin adoption. And that's going to be very positive for crypto overall. So this is a trend that might take 6 months to 1 year to start to reflect on prices. But I think it's a very strong demand that's coming from stablecoins, and that's going to move the crypto markets in the coming months.
Can I ask you, Samir, just the Trump administration, I mean, the most, crypto-friendly administration we've seen. As just somebody who's working in the industry day in and day out, what is your review so far of the Trump administration as it relates to crypto? What do you make of what you've seen and heard?
When it comes to crypto, I think we're having a great administration. We're finally having an administration that listens to the industry, that tries to come up with good policy, that tries to balance innovation and investor protection. We're seeing this on how the SEC is approaching this subject, how the CFTC is approaching this, even how the White House and the Congress are approaching this. So we just got a huge milestone for stablecoin adoption, the Genius Act. That's huge for crypto. And this is a much needed regulatory clarity to start to see financial institutions to get comfortable with the space. So we're certainly seeing like a big difference in how this administration looking at this. If we look at Bitcoin specifically, having the US government going out and saying that Bitcoin is a store of value for the 21st century is a big move. That moves all the other countries, all the other central banks are looking at this, and they're looking at what their strategy is going to be for Bitcoin. So certainly this is accelerating our investment thesis for crypto.
Samir, let's talk about the news from you all over at Hashdex. You're expanding, you're bringing investors access to, it sounds like, these other crypto assets. Walk us through this news. Explain this new product, Samir.
Yeah, so Josh, this is a very exciting news for us. So we've launched in February of this year the first multi-asset crypto ETP in the US, the Hashdex Nasdaq Crypto Index US ETF. That tracks an index that was created by Nasdaq to be a benchmark for crypto, to be like a Nasdaq 100 for crypto. So when we launched this back in February, we could only have Bitcoin and Ether as components in a crypto ETP. Recently, we got the generic listing rule approved by the SEC, and that rule basically sets a standard that if an asset satisfies that standard, it can be included in a crypto ETP. So recently, we've changed the listing rule of our products from a specific listing rule that was approved in February to this generic listing rule. And what this allows us is to expand the NCIQ over time. So right now we expanded from 2 assets, just Bitcoin and Ether, to 5 assets. So now including Solana, XRP, and Stellar. And over time, as more assets satisfy both the index methodology, the index eligibility rules, and the generic listing rules, they can be included in the index. So this makes it a product that's evolutive, that can evolve over time as the market evolves. We believe that we're very early in the adoption. It's too early to pick the winners. And the best approach for the majority of the wealth managers is to just have a broad exposure to the market. And this is what this product it's proposing to bring to investors. It's a simple way with one click to have a broad exposure to the market, and one that's evolutive, that's going to grow as the market evolves.
And if I'm an investor, Samir, I'm listening to this, how should I kind of just think through the risk reward of adding such altcoins to my portfolio?
So the way we think that investors should approach this space is like they approach any other space. So they should be looking at a benchmark index and having their core allocation onto that benchmark index. And then they can express their opinions on active calls. So if you believe that, so if you think about it, crypto has $4 trillion in market capitalization right now. This is like 1 to 2% of the investable assets in the world. So if you're looking for a market cap passive allocation, global allocation, you should consider a 1 to 2% allocation to crypto. And when we think about crypto, you should look at the space in a broader range, not just Bitcoin, but also not just trying to pick the winners and trying to go through your due diligence and trying to understand the investment case for Ethereum, for XRP, Solana, Cardano, and all the other thousands of crypto assets. So you choose a benchmark, you look at the market and you choose a benchmark, and you start tracking this benchmark. Over time, if you want to express and if you want to be overexposed to crypto, you can increase that allocation above the market cap weighted. If you want to decrease your allocation, you can remove it as well. If you want to express this in sector allocations, you can do it as well. But we believe that a crypto allocation starts, just like with any other asset class, starts with a benchmark diversified index.
Samir, great to have you on the show today. Thank you, sir.
Thank you so much, Josh.
We are wrapping up today's Market Domination, but don't go anywhere. We've got you covered with all the action. Following the closing bell, stay tuned for Market Domination Overtime.